So let us start mutual funds. Mutual funds concept, mutual funds weightage, mutual funds topic weightage, 7 marks descriptive and 2 marks MCQ. 2 marks multiple choice question. Okay, for this grant test, I have already selected questions. Okay, after analyzing all past papers, CA final and CMA final, I have selected questions. You will get questions from the same concepts which we have discussed in revision series, but I can bet you, you will not be able to do, I mean, at least you will commit some mistakes. You will commit some mistakes. Sahil compliment, nice voice. Please send them to Idol Singer. Okay. Sure, sure, Sundar.
Thank you.
Okay. Mutual funds. Mutual funds is a trust that pulls together resource of investors to make investments in the capital market. Okay. Mutual funds is a trust that pulls together the resources of investors to make investment in the capital market. So mutual fund actually is a part of a portfolio management. I mean, so what mutual funds will do? Mutual funds is a trust. Mutual funds will be pooling the investment from the investors, and the mutual fund is managed by the fund manager, who is a qualified CA or a cost accountant or a CFA, chartered financial analyst. So this fund manager will be investing in securities, various securities like shares, bonds, and money market instruments on behalf of the investors, Okay. And the advantages or objective of a mutual fund is to diversify the risk. So why we have a concept of mutual funds? Because the reason, whoever wanted to invest in stock market, so they might have two deficiencies. First, time. They may not have a time to analyze the security, analyze the portfolio, or else they may not have enough knowledge to analyze the security and portfolio. So that's why people will make investment in mutual funds, and this mutual fund is managed by a professional fund manager. And this professional fund manager, what? So who is having a knowledge of portfolio management, will analyze the securities, will analyze the portfolio, and will make investment on behalf of the investors. So what are the advantages of mutual fund? Diversification, liquidity. Okay, you can take back the amount at any point of a time. Professional management, economies of a scale. Economies of a scale means fund manager will be collecting amount from the investors. Large amount is collected, and so altogether, okay, will be invested in securities. Economies of a scale means what? Large scale. So investment is made in large scale. Due to that, what happens? Fund management expenses will decrease. So mutual funds topic is very simple topic. If you know the portfolio management basics, so mutual funds will be easy. So first you should know the meaning of NAV. NAV is a common term we use in mutual funds. NAV. NAV means a net asset value. It is equal to net worth. It is nothing but net worth, equity fund or a proprietary fund. Net asset value. How do we get net asset value? Total assets minus outside liabilities. First you have to visualize the balance sheet of a mutual funds. In mutual fund balance sheet, you will find securities. Only securities, cash balance, and any receivable. That's it. You will not find any plant and machinery. You will not find any land and buildings. You will not find any other kind of asset. You will find only securities, cash balance, and what? Receivables. What about liabilities? You will not be taking any loan from banks, because mutual fund is a trust. So mutual fund will not be taking any loans. Mutual fund will not be issuing any debentures or a preference shares. Okay, on liability side, mutual funds will have only what? Accruals. Accruals means expenses payable, or else what? NAV, net asset value, the amount collected, capital collected. So how do we get NAV? NAV is equal to total assets, securities plus cash plus receivables minus what? Expenses payable. NAV. So we calculate holding period return. Here the holding period return formula is similar to what? Holding period return formula is similar to P1 minus P0 plus D1 divided by P0. Instead of P1, we take NAV 1. Okay, NAV 1 minus NAV 0 plus I divided by NAV 0. Here I means income. NAV 1 means net asset value at the end of the first year. NAV 0 means net asset value at the beginning. So how this net asset value increases? Simple. Portfolio manager will make investment in securities. And if security value increases, so what happens? The investment value will increase, portfolio value will increase. If portfolio value increases, what happens? Automatically, net asset value of unit holders will also increase. In company, we call them as shareholders. Here we call as unit holders. Company will be issuing shares. Here mutual funds will be issuing units. Okay, annualized return. So holding period return is different from the annualized return. Holding period means an investor may hold the mutual fund for a period of 1 month or a 2 months or a 3 months. If you are calculating a return for 1 month, 2 months or 3 months, it is called as what? Holding period return. So okay, annualized return means nothing but we convert this holding period return into annual per annum. How do we get annualized return? Annualized return is equal to holding period return into 12 divided by n. HPR, not MPR. HPR divided into 12 divided by n. And next, mutual fund earnings. Mutual fund earnings. You might get MCQ on this concept. R2 is equal to R1 divided by 1 minus initial expenses plus recurring expenses. R1 means personal earnings. R1 means what? Personal earnings. So the earnings, the rate of a return which can be earned by the individual on his own. But if he is investing in mutual funds, he has to incur initial expenses. Okay, mutual fund has to incur initial expenses, and mutual fund has to incur what? Recurring expenses. Every year has to incur expenses. Okay, so that's why they will ask you a question. If you can refer the question number 1, simple question, or MCQ. In bullet MCQs, I'm going to discuss this concept. R2 is equal to R1 divided by 1 minus initial expenses plus recurring expenses. Next, so basic formula is set 2. Front end load. Front end load means that the charges collected by the mutual funds at the time of issue. In this class, I am going to discuss CA final September 2025 mutual fund question. So in September 2025 CA final, 2 questions were asked. Okay, out of 2 questions, 1 question is easy and 1 question is little tricky. Okay, so if you want to answer that second question, you should know the meaning of front end load and back end load. Front end load means charges collected at the time of issue. Back end load means the charges, okay, collected at the time of redemption, at the time of repayment. So how do we get front end load percentage? Front end load percentage is equal to public offer price minus NAV. Difference is the front end load. So if you have to calculate the percentage, front end load, okay, public offer price minus NAV divided by NAV. Back end load is equal to NAV minus redemption value divided by NAV. Okay, clear? Next, so other important formulas, generally students will be ignoring these concepts. So these are very important. So tested in the past, and for the past 2-3 attempts, they were not asking this concept, but highly anticipated, highly expected questions. Morningstar index. How do we get Morningstar index? Average return minus risk of a loss. Risk of a loss is different from the risk. Risk means possibility of occurrence of a loss. You might get confused. Risk is measured by using standard deviation, variance, or a coefficient of a variance. Risk is different from the risk of a loss. Risk of a loss means loss we incur due to the risk. Further, we have a question. We are going to discuss the question, last question, question number 21. So that is highly anticipated question. Okay, so this concept is not there in CA final. In CMA final, we have this concept and it was already tested in the old syllabus. Okay, so pharma's net selectivity, it is also the concept. So pharma's net selectivity, total gain, Jensen's alpha, actual return minus CAPM return, actual return minus CAPM return. Nothing but Jensen's alpha itself is what? Pharma's net selectivity, total gain. And pharma's net selectivity, net gain is equal to actual return minus CML return. I hope you remember the CML return. CML return is equal to RF plus RM minus RF into sigma S divided by sigma M. Yes or no? Pravalika. So tell me, what is the Morningstar index? Morningstar index.
Average return minus risk of loss.
Very good, Amma, very good. Morningstar index is equal to average return minus risk of a loss. Pharma's net selectivity, total gain. You only.
Actual return minus CML return.
Actual return minus CAPM return.
Net or total gain.
Total gain. Net gain.
Net gain. Actual return minus CML return.
Actual return minus CML return. Very good, Amma. Please comment on voice of Pravalika. Everybody, please. Next, miscellaneous formulas. Miscellaneous formulae. Capital appreciation. Capital appreciation. Closing NAV minus opening NAV. Closing NAV minus opening NAV. Expense ratio. Expense ratio. Okay, you might get MCQ. Expense ratio. Total expense divided by average value of a portfolio. Total expenses divided by average value of a portfolio. For example, expense ratio is equal to 5%. What is the meaning of this? So if you are investing, fund manager is investing 100 rupees, out of 100, 5 rupees expenses. 5 rupees what? Expenses. So the expense ratio should be as low as possible. As low as possible. Okay. And return. We get return in the form of capital appreciation and also what? Income. Income can be in the form of dividend and what? Capital gain. Capital gain. Clear? And we have a concept of TWROR. It was not tested, okay, from the past 7 or 8 years. TWROR, time weighted rate of a return. And also we have a money weighted rate of a return. Money weighted rate of a return is nothing but IRR. TWROR, okay, is also simple concept. 1 plus R1 into 1 plus R2 into 1 plus R3 into 1 plus R4 minus 1. So this concept I will explain with the question, okay? I will explain with the question. So these are the only formula we are going to use in this mutual funds. In this mutual funds, we have a overall, how many practice questions? How many practice questions? 8 practice questions. 8 practice questions. Okay. So once again, I am challenging you. I am going to discuss questions in this class. Okay, so day after tomorrow, we have a grant test, SFM grant test. In that SFM grant test, if I give you a question, you will not be able to do. Okay, you will not be able to do, okay? So once again, I'm repeating this, okay? I will test you the known concepts, but, okay, when the text changes, you will get what? Panicked, okay? Can anybody please share this mutual fund concept in Telegram group? Okay. Sahil, I will share you later on after the class. Shall we move on to the questions? Come on, without wasting the time. So question number 3 is not tested in the past, but to know the basic concept of a mutual fund, how the incentive is paid to the fund manager. How the incentive is paid to the fund manager. Fund manager will be receiving what? Fund manager will be receiving a first, irrespective of a fund performance, okay, so fund manager will take certain percentage as a fund management charge. Okay, so for example, in this question, 0.1% of a portfolio asset, 0.1% of a portfolio asset will be taken as what? 0.1% of portfolio asset will be taken as fund charges. So this is irrespective of a management of a fund, fund performance. In addition to that, they will be taking what? Incentive. In this case, incentive 2%. Incentive 2% will be paid only if a fund performs well. Here in this case, 2% incentive is paid if the fund value increases beyond the maximum value we achieved till date. So till date, so the maximum value we have achieved is 21 crores. 21 crores. So what is the incentive we are going to pay? We are going to pay incentive only if a value exceeds 21 CR. And the incentive 2% will be paid only on that excess. Okay. So this is a simple question. For suppose first case, what is the return on the fund? 29%. What is the fund? 20 crores. 20 crores return 4.9 means 29% means 20 into 129%. See what is 20 into 129%? 20 into 129%. 25.8 crores. 25.8 means which is excess of 21. What is excess amount? 4.8. So 4.8 into 2%, 9 lakh 60,000. So 9 lakh 60,000 is the incentive plus what? Basic charges. 20 crores into 0.1%, 2 lakhs. Total 2 lakhs plus 9 lakh 60. 11 lakh 60. 11 lakh 60 will be paid. Are you getting my point? So next is 4.5 and minus 1.8. In that case, he will not be getting any incentive. He will get only base charges 2 lakhs. Okay. So question number 4, this is a frequently asked question and it is tested in multiple choice question as well. Multiple choice question. This is a basic question. Okay. An investor purchased 300 units of a mutual fund. So this is not for practice. An investor purchased 300 units of a mutual fund. Pravalika, please read the question as soon as possible. Please, fast. Be fast. Come on, please.
An investor purchased 300 units of a mutual fund at 12.25 per unit on 31st December 2009. As on 31st December 2010, he has received 1.25 rupees as dividend and 1 rupees as capital gains distribution per unit. Required. The return on the investment if the NAV as on 31st December 2010 is 13 rupees. The return on the investment as on 31st December 2010 if all dividends and capital gains distributions are reinvested into additional units of the fund at 12.5 rupees per unit.
Very good, Amma. Thank you. So first part they are asking a return on a investment. What is the NAV at the beginning? 12.25. What is the NAV at the end? 13. So meanwhile we received, investor received a dividend of 1.25 and a capital appreciation, capital gain of 1 rupee. So what is the per unit income? 2.25. Yes or no? So how do we calculate holding period return? Holding period return is equal to NAV1 13 minus 12.25 plus 1.25 plus 1 divided by 12.25. So the answer is 24.49%. So there can be a dividend reinvestment plan. Dividend reinvestment plan means whatever the income received will be reinvested again. Reinvested again. So that point you have to understand. Whatever the dividend received will be reinvested again. In this question, the return on investment as on 31st December 2010, if all dividend and capital gain distributions are invested into additional units of the fund at rupees 12.5 per unit. So whatever the dividend received, reinvested at the rate of 12.5 per unit. So be careful, holding period return, we are calculating on a per unit basis. But in second case, we cannot calculate on a per unit basis because number of units are not same at the beginning and at the end. So what is the overall? How many units are there? 300 units. And what is the income? 2.25. 300 into 2.25, 675. So this 675 reinvested at the rate of 12.5. So 54 units. So overall units at the end, 354 units. And what is the NAV at the end? 13 rupees. So 354 into 13, 4602. So what is the price paid at the beginning? 300 into 12.25. So return is equal to 4602 minus 3675 divided by 3675. So what is the percentage? 25.22. 25.22. Am I clear? Done. So now, today in the evening, you refer question number 5, question number 6. With refer, you can understand. Question number 7 also, you have to refer this question. In question number 7, there is only one special point. Other fixed income securities. Current realizable value of fixed income securities of face value of rupees 100. That has to be ignored. That point has to be ignored. Okay. So because later on again one more sentence is given. Other fixed interest securities are at cost. Whenever two sentences are given, we should give importance to what? Second sentence. When there are two sentences which are contradicting with each other, we should give importance to what? Second sentence. For suppose tomorrow we do not have a class. This is my sentence as of now. Okay. But now I am saying again, tomorrow we have a class. So which is valid? Second one is valid. First one is invalid, right? Okay. Clear? Next, we are moving on to the practice questions. Okay. 9th question is also simple question. 10th. So that doesn't mean these questions will not be asked in examination. These questions are easy, and you in the evening you have to refer these questions, okay? So this 11th question, this was tested in June 2025. 11th question tested in June 2025. The only additional point given is in mutual fund Z, bonus issue. Bonus issue. Bonus issue means what happens to the number of units? Number of units will increase. Number of units will increase. Clear? So question number 11. So this question number 12 is the first practice question in mutual funds. This question we have to practice because this is a CA final recent past examination question. This question has to be practiced. Question number 12. So first I will read the question and next you practice. Question number 12. Question number 12. Okay, Sai Kirti, please read the question.
Mr. X on 1/7/2012, during the initial public offer of a mutual fund, invested 1 lakh at face value of rupees 10. On 31st March 2013, the mutual fund declared a dividend of 10 rupees when Mr. X calculated that this holding period return was 115%. On 31st March 2014, mutual fund again declared a dividend of 20%. On 31st March 2015, Mr. X redeemed all his investment, which has accumulated to 11,296.11 units when his holding period return was 202.17%. Calculate the NAV as on 31st March 2013, 31st March 2014 and 31st March 2015.
So this question is for practice. Mr. X on 1/7/2012, during the initial public offer, invested 1 lakh. What is the face value? 10 rupees. That means how many units he bought? He bought 10,000 units, right? On 31st March 2013, the mutual fund declared a dividend of 10%. Mutual fund declared a dividend of 10%. So that means how much amount he will be getting? Okay, 1 lakh into 10%, 10,000. So when Mr. X calculated that his holding period return was 115%, holding period return was 115%, 115. So remember this point, instead of giving 115%, holding period return is equal to 115%. Remember again, I'm repeating this point, instead of giving holding period return 115%, they might mention annualized return 153.33. 153.33 instead of once again repeating, instead of giving holding period return, they might give annualized return 153.33. Okay, so why I'm repeating? Because the reason 1st July to 31st March, how many months? 9 months. Okay, so 9 months return is directly given in the question, 115%. Instead of giving directly 115%, they might give 153.33%, which is annualized return. So we should convert that 153.33% annualized return into holding period return. So that is 153.33 into 9 divided by 12. 9 divided by 12. So then you will get 115%. Clear? And last line, holding period return was 202.17%. On 31st March 2015, holding period return was 202.17%. Instead of giving 202.17% holding period return, they might give annualized return 73.52. So we have 3 questions in CA final study material, but I have given only 1 question in our material because the only difference is what? Instead of giving holding period return, they might give what? Annualized return. If annualized return is given, first you should convert that annualized return into holding period return. Because why? So what is the holding period return first case? 115%. 115%. So they are asking you to find out the NAV as on 31st March 2013. NAV at the end. NAV at the end. You know the formula for holding period return. What is the formula for holding period return? Holding period return is equal to NAV1 minus NAV0 plus income divided by NAV0. So what is NAV1 here? Not given. We have to find out. Okay, but holding period return is 115%. That means 1.15. 1.15 is equal to NAV1 minus 1 lakh. So 1 lakh is what? NAV not. NAV not. Clear? plus dividend divided by what? NAV not. So 2,05,000 is the NAV 1. We should find out per unit. NAV per unit is equal to 2,05,000 divided by 10,000, 20.5. In this question, special point is the second part. What is the second part? NAV as on 31st March 2014. How can we find out the NAV as on 31st March 2014? 31st March 2014. Simple. 31st March 2014 means if you see the number of units in the beginning 10,000, but at the end 11,296.11. How come the number of units increased? Because here it is a dividend reinvestment plan. Dividend reinvestment plan means whatever the dividend received, we are again reinvesting. At what rate we are reinvesting? The rate is not given. If rate is not given, we assume that the investment is made at the rate of NAV on that particular date. Clear? So on 31st March 2013, how much dividend we received? 10,000. So that 10,000 will be reinvested at the rate of 20.5. So how many units we are going to purchase? 488. 488. So overall 10,488 units. 10,488 units. On this 10,488 units, on 31st March 2014, again dividend is declared 20%. So we receive a dividend 10,488 into 10 into 20%. How much dividend we are going to receive? 20,976. Okay. Clear? At the end we have 11,296.11 units. Yes or no? As on 31st March 2014, how many units we have? 10,488 plus. On the same day, we purchased units. We don't know how many units we purchased. But the difference between this 10,488 and 11,296.11 is nothing but what? Number of units purchased on 31st March 2014. On 31st March 2014, what is the dividend received? 20,975.6. So here it is a critical part. We are assuming that NAV as on 31st March 2014 is equal to X. We know the amount reinvested. Amount reinvested divided by NAV per unit on that particular date is equal to what? Number of units. Yes or no? Are you getting my point? You should understand this equation. Everybody please, online students, you should understand this equation. 10,488 plus. Again we bought units. We do not know how many units we bought, but we know the amount reinvested. What is the amount reinvested? 20,975.6 divided by, we don't know the NAV per unit. So we are assuming it as X. That should be equal to what? 11,296.11. So this is a special point in this question. Everybody, is it clear? I'm a little bit fast, but if you are not able to understand, I will explain. No problem. Holding period return is equal to 202.17. So the clue is given to find out NAV as on 31st March 2015. Holding period return 202.17. So 202.17 is equal to 202.17 is equal to NAV 1. We do not know NAV 1, but we know NAV at the beginning. What is NAV at the beginning? 1 lakh divided by 1 lakh. Holding period return means that is a return from what? 1st July to 31st March 2015. Overall holding period return is given. We know the investment at the beginning. What is the investment at the beginning? 1 lakh. So we have to find out the investment value at the end. So tell me what is the answer? 26.75. So now, I request everybody, so Swati, Harshini, all Chennai students. Okay. So I request everybody to pause the video and solve this question within 10 minutes. This is a recent CA final past questions. Okay. Clear? Now the time is 3:45. By 3:55, you have to complete this question. Students who are not able to, okay, so understand, at least try to go through the solution. Fast with presentation, be fast. So done. Now question number 13. Question number 13 is also for practice. Question number 13 is also for practice. So this is a CA final past question and also CMA final past question. So Sun Moon Mutual Fund, approved mutual fund, sponsored open-ended equity oriented scheme, Chanakya Opportunity Fund. There were 3 plans. A, dividend reinvestment plan. B, bonus plan. C, growth plan. At the time of public offer on 1/4/1999, Mr. Anand, Mr. Bachchan, Mrs. Charu, 3 investors invested rupees 1 lakh each and chosen B, C and A plan respectively. On 1/4/1999, Mr. Anand, Mr. Bachchan, Mrs. Charu, 3 investors invested rupees 1 lakh each and chosen B, C, A plan respectively. Ignore the names Anand, Bachchan and Mrs. Charu. You remember the plans. A, dividend reinvestment plan. B, bonus plan. And C, growth plan. The history of the fund is as follows. Date, dividend percentage, bonus ratio, net asset value per unit. Plan A, plan B and plan C. 28 July 2003, 31st March 2004. So 31st December, likewise dates are given, dividend percentage is given, bonus ratio, net asset value per unit, plan A, plan B, plan C. So first plan, dividend reinvestment plan. Dividend reinvestment plan means what? Whatever the dividend received will be reinvested. Whatever the dividend received will be reinvested. Okay, clear? Whatever the dividend received will be reinvested. So that means what happens? The number of units will increase. Number of units will increase. So that means I cannot calculate the holding period return on per unit basis. Clear? And next what? Plan B, bonus plan. Bonus plan means what? Again, number of units will increase. Number of units will increase. Last plan, growth plan. Growth plan means what? Number of units will remain same. Number of units will remain same. So, but here some special points are given. On 31st July 2009, all 3 investments redeemed all the balance units. On 31st July 2009, all 3 investors redeemed all the balance units. Calculate annual rate of a return to each of the investors. They are asking you to find out the annual rate of a return. Consider long-term capital gain is exempt from income tax. So till now we have not come across this special points. Long-term capital gain is exempt from tax. Short-term capital gain is subject to 10% income tax. Security transaction tax 0.2% only on sale or redemption of a unit. Ignore. Education says short-term capital gains tax is given 10% of a 10%. Okay. And next what? Security transaction tax is given 0.2%. Security transaction tax is levied on sale value. Levied on a sale value. Okay. So first I will explain the problem, then you do it within the time. Calculation of annual rate of a return. So first to find out the calculation of annual rate of a return, we should find out the closing units, closing number of a units. For that I am taking date, dividend reinvestment, NAV, units bond and closing balance. On 1/4/1999, what is the amount invested? 1 lakh is invested at the rate of 10 rupees. At the rate of 10 rupees. That means how many units we are purchasing? 10,000 units. So next on 28th July, dividend is declared at the rate of 20%. So that means what is the dividend amount received? 10,000 into face value 10 rupees. Dividend is always paid on face value. 10,000 into 10 into 20%. Unless they have mentioned it is payable on paid up value. So dividend is what? Paid on, applied on face value. Rate is applied on face value. 10,000 into 10 into 20%. 20,000. What is the NAV on that date? Dividend reinvestment plan? 30.7. 30.7. So units bought 651.465 and closing balance is 10,651.47. 10,651.47. Again next 31st March 2004, 31st March 2004, dividend is declared. Okay. So what is the percentage dividend declaration? 70%. 10,651.47 into 10 into 70%. 74,560.29. So what is the NAV on that date? 58.42. So again, 1276.28 units are bought. Closing units 11,927.75. Are you able to understand? So this is how we calculate the number of units. Closing number of units are 14,906.16. Okay. So this is a practice question because you should first take the columns. What are the columns we need to take? You should get an idea how to start the question. So next, how many units? 14,906.16 units sold at the rate of. So sale is made on 31st July. Sale is made on 31st July 2009. So on 31st July 2009, what is the NAV? 53.75. Dividend reinvestment plan. So 14,906.16 into 53.75 minus security transaction tax. Net amount received. And next what? Short-term capital gain tax. Short-term capital gains tax is applicable if sold within 1 year. Yes or no? So we are selling on 31st July. So what was the previous purchase? The previous purchase is on 24th March. 24th March 2009. 24th March 2009 means within 12 months. So that's why short-term capital gains tax is applicable on the purchase made on 24th March. What about 31st March 2008? 31st March 2018, sir. 8 means more than a year. More than a year. So that's why short-term capital gains tax is applicable only on the purchase made on 24th March. How many units were purchased? 1144.43 into sale value 53.75 minus cost of acquisition 48.1 is the cost of acquisition. The NAV on that purchase date into what? 10%. So what is the net amount received after the payment of tax? 7,98,956. So 7,98,956 minus 1 lakh divided by 1 lakh into, we should analyze. How can we analyze? 12 divided by n. 12 divided by n. N means holding period. So what is the holding period here? We made investment on 1st April 1999. And we sold on 31st July 2009. That means 10 years plus 4 months. So that's why 124 months. Okay. So capital appreciation. Our investment is 1 lakh. Value of investment is 1 lakh. 1 lakh value has increased to 7,98,956.69. Capital appreciation divided by investment at the beginning into 12 divided by 124. So what is the rate of return? 67.64%. Clear? So in examination they might reduce what? As they are asking question for 7 marks, they might reduce what? Either they give 2 plans or else what? They give less number of dates. Less number of dates. But this concept might be tested in exam. Okay. Plan B. What is the plan B? Bonus issue. On 1/4/2009, how many units are purchased? 10,000. Bonus issue is made on 31st March. What is the ratio? Bonus ratio? 5:4. 5:4 means for every 4 units, 5 bonus units are issued. 5 bonus units. So 10,000 into 5/4. 12,500. So 22,500. Clear? And next 22,500 into bonus is issued in the ratio of 1:3. So 1/3. 7,500. So what are the closing number of units? In case of bonus plan, 37,500. So 37,500 units sold at the rate of 22.98 minus security transaction tax. Clear? And be careful with the short-term capital gains tax. Short-term capital gains tax in CA final study material, multiple answers are given, but I have taken an appropriate answer. Okay, in CMA final also, CMA final appropriate answer is given. Short-term capital gains tax. Short-term capital gains tax is applicable only if sold within 1 year. So the previous purchase was made on 24th March 2009. That means these 7,500 units are sold within a year. What about the 31st March 2008? So Lakwani, so PDF is shared in Telegram group. So we have a paper number 14 Telegram group. Please join our Telegram group. In that group, you will find the PDF. So here 7,500 units were sold within the year. So short-term capital gains tax is applicable. Be careful, you might commit a mistake. For bonus units, cost of acquisition is. For bonus units, cost of acquisition is. You know the direct tax is better than me. So for bonus units, cost of acquisition is equal to what? 0. For bonus units, cost of acquisition is 0 because you are getting them at a free of a cost. So that's why. So short-term capital gain. So the given ratio is in the question, Mahima Singh. 5:4, 1:3, 1:4. Bonus ratio. So now, short-term capital gains tax, 7,500 into what is the sale value? 22.98 into direct 10%. Why we are directly multiplying with 10%? Because cost of acquisition is 0. That's why. Okay. So what is the value of investment at the end? 8 lakh 42 791.5 minus value of investment at the beginning divided by 1 lakh into 12 divided by holding period. What is the holding period? 124. So 5/4, Mahima Singh. So 5:4 is given in the question. Bonus ratio. Bonus ratio. Clear? Very good. Mahima Singh, nice emoji. Thank you so much. Normal emoji. Okay. 71.88%. 71.88% is the answer. Clear? Next, growth plan. Growth plan means what? Number of units will not change, will remain same. So how many units are there at the beginning? 10,000 units. What is the NAV? NAV at the end, 82.07 minus security transaction tax. So short-term capital gains tax is not applicable for this question. Why? For this plan. Because there was no purchase from the last 124 months. So that's why. So answer is 69.59%. Clear? Okay. So now the time is 4:05. By 4:15, complete this solution. I have a patience. Let me know. If you have a patience, then let me know. I will give a time to each and every practice question. I will explain and I will give a time to practice each and every question. You are busy. You will not be giving time. Solve this question within 10 minutes. If not, at least 12 minutes. And if students, if you are not able to complete within the time, then okay, do not worry. At least what? Stop practicing. Go through the answer. Try to understand the answer. Later on, after completing this class, again sit and practice. Okay, please do not give up. Okay. Sahil, भगाएंगे SFM को. खाली SFM को नहीं, DT को भगाएंगे. Direct taxes. All 8. Very good. So clear? Now let us move on to the next question. This is also a practice question. This is a CA final May 2023 question. CA final May 2023 question. Okay. So this is a tricky question. Question number 14, tricky question. Messrs. Promising an AMC on 1/4/2018 has floated two schemes, dividend reinvestment plan and bonus plan. Mr. X, an investor, has invested in both the schemes. Mr. X, while submitting the tax papers, returned a capital loss. He returned a capital loss on both the plans. Tax officials, suspicious on the claim of a Mr. X, decided to launch an investigation and were able to collect the following details except the issue price. They are able to collect the following details except the issue price. So this happens only in CA and CMA questions. Okay, you know, single entry, fire occurs, we will be losing all the information except what few data. Okay, how it can happen? Okay, so likewise here also issue price, except issue price, they got every information. So date, dividend percentage, bonus ratio, NAV, dividend reinvestment plan, bonus plan. On 1/4/2018, question mark and question mark. It is not a printing mistake. We have to find out NAV, net asset value. It's issue price. We have to find out the issue price. In previous question, issue price was 10 rupees. Face value and issue price are same. 31st December 2019, 31st March 2020, 31st March 2021, 31st March 2022, and 31st March 2020, 31st December 2022, 31st March 2023. See incised answer. See incised answer. In question paper, this row got typed before the row of values of 31st March 2022. So this is enough, okay, in exam center to get confused and all. So they have given a note incised answer. Okay. Additional details. Additional details. Dividend reinvestment plan, bonus plan, investment, average profit, average yield percentage. Assume the face value of a unit as rupees 10. You are required to assist the tax officials to calculate the issue price of both the schemes as on 1/4/2018. As on 1/4/2018. So we are required to assist what? Tax officials in finding what? Issue price of both the schemes. First scheme is what? Dividend reinvestment plan. So what is investment? 10,80,000. 10,80,000 is the investment. Clear? 10,80,000 is the investment. What is the average profit? 1,21,824. This average profit is nothing but profit per annum. Profit per annum. Clear? Okay. So investment is made on 1/4/2018. Investment is made on 1/4/2018. Yes or no? And investment is held up to 31st March 2023. So that means how many years investment is held? 18 to 23. 5 years. 5 years. So tell me, what is the investment value at the end? Investment value at the end will be 10,80,000 plus 10,80,000 plus profit per annum is 121,824. Overall profit is 6,09,120. That means total investment value at the end will be 16,89,120. So what is the NAV on that particular date? I mean NAV at the end 80. NAV at the end is equal to 80. So number of units 21,114. So these are the number of units at the end. So these are the number of units at the end. 21,114. So clear? So now I will write the answer. $21,114. 21,114. 21,114 is what? Number of units at the end. Number of units at the end. Okay. So we do not know what is the issue price at the beginning. Let issue price is equal to what? X. Let the issue price is equal to X. So this is a tricky question. Let issue price is equal to X. So number of units at the beginning is equal to 10,80,000 divided by X. 10,80,000 divided by X. Yes or no? Okay. plus next dividend is declared on what? Next dividend is declared on which date? 31st March 2020. That means number of units bought on 31st March 2020 is equal to, see this calculation carefully. So what is the calculation? Number of units bought on 31st March 2020. What is the dividend percentage? 12%. That means 10,80,000 divided by X. Face value is already given in the question. What is the face value? 10. 10,80,000 divided by X into face value 10 into what is the percentage? 12%. Then you will get dividend. You will get dividend. But we are finding out number of units bought on 31st March 2020. What is the NAV on 31st March 2020? What is the NAV on 31st March 2020? 60? 60. Everybody are able to understand this calculation. 10,80,000 divided by X. You will get number of units at the beginning into face value 10 into 12% into what? 1 divided by 60. So tell me, so the simplification. After simplifying, what is the number? 21,600 divided by X. So next total units will be 11,01,600 divided by X. Yes or no? Clear? Okay. Again we add number of units bought on 31st March 2021. So tell me the calculation. 11,01,600 divided by X into face value 10 into how much percent? 10% into 1 divided by 68. After simplification, the number is 16,200 divided by X. Total 11,17,800 divided by what? X. Clear? Likewise, we find out what? Likewise, we add number of units bought on the next date. How many times the dividend is declared? 3 times. Okay. Next, add. How many units are purchased? 11,17,800 divided by X into 10 into 10%. How much? 15%. I'm sorry, 15% into what? 1 by 75. 22,356 divided by X. Clear? So total. So 11,40,156 divided by X. These are the number of units at the end. We already know the number of units at the end, yes or no? So what is the equation? 11,40,156 divided by X equal to 21,114. So X is equal to, my writing is not good, please adjust, okay? X is equal to 54. X is equal to 54. Clear? So this is the issue price. This is the issue price. This is the issue price. Am I clear? Likewise, we have to do for the bonus plan. For bonus plan, the only difference is what? They have given, for bonus unit, they have given what? Average yield percentage is given. Yield percentage. I'm not focusing on presentation, I'm just focusing on the answer. What is the investment at the beginning bonus plan? 10 lakhs. Okay. So tell me how many, what is the yield? So 10 lakhs into 8.4% into how many years? 5 years. 4,20,000. That means 40,20,000 is the value of investment at the end. So tell me the closing units. Closing units is equal to 14,20,000 divided by what is NAV? 71. So 20,000 units at the end. Clear? So let us assume the issue price in bonus plan is equal to Y. Okay. Let the issue price under bonus plan is equal to what? Y. So in that case, what happens? So tell me. So first beginning unit 10,80,000 divided by what? Y. These are the beginning units. Yes or no? So 10 lakhs. I'm sorry. 10 lakhs divided by Y. So these are the number of units. These are the number of units. So 10 lakhs divided by Y. Number of units at the beginning plus 31st December 2019. What is the bonus ratio? 1:5. That means how many units you are going to get? 10 lakh divided by Y into 1/5. 2 lakh divided by Y. So total will be 12 lakhs divided by Y. Again the bonus issue. Again bonus issue. Okay, again bonus issue. What is the ratio? 1:3. So 12 lakhs divided by Y into 1/3. 4 lakhs divided by Y. So 16 lakhs divided by Y. Again bonus issue is there or not? No bonus issue. So that means this 16 lakhs divided by Y is equal to 20,000. So Y is equal to what? 16 lakhs divided by 20,000. Y is equal to what? 80 rupees. Y is equal to 80 rupees. Am I clear? Done. Y is equal to rupees 80. Clear? Everybody are able to understand this question? I have not focused on presentation. Simple. The thought you have to get is, let us assume the issue price is equal to X. Okay, first we should find out the closing number of units. We should find out the value of investment at the end, and next what? Closing units. Clear? Bonus plan is also the same, but the yield is given, percentage is given. Okay? Clear? Everybody, is it clear? Now let us come to the CA final question, September 25. This is also a tricky question. September 25 question is also a tricky question, okay? In 2024, Mr. Raj, an investor made a lump sum investment in an equity mutual fund that had an entry load of 0.05 per unit. That had an entry load of rupees 0.05 per unit. So what is the amount of investment made is not given. By the end of the year, the NAV appreciated by 13.60%. So NAV has got increased by what? 13.6%. Additionally, the fund declared a total capital gain and dividend of rupees 5 per unit. So what is the capital gain and dividend declared? 5 rupees per unit, which were reinvested at an year-end NAV of rupees 25. As a result, the investor held 15,000 units at year-end. Okay, as a result, the investor held 15,000 units at year-end. So units at the end are given. The fund also charges an exit load of 1% if redeemed within 1 year. The investor is in the 20% tax bracket. Inflation rate during the year is 4.5%. What is the inflation rate? 4.5%. you are required to calculate the number of units purchased by Mr. Raj at the beginning of the investment. We have to find out the number of units purchased at the beginning of the investment. Calculate the NAV per unit and the total investment amount made by Mr. Raj at the beginning of the year. At the beginning of the year. And third, appraise the return percentage and the real return percentage if Mr. Raj decided to exit the investment at the end of the year. At the end of the year, if he wants to exit, so find out the return percentage, and also what they are asking you to find out the real return. So what is this real return? For that, we have to know the real rate and the nominal rate. So that we are going to discuss in capital budgeting topic, but here I will explain. But meanwhile, so take at least 5 minutes time and try to find out the first part. For suppose the same question appears in examination, you don't know. So you should know how to try the new question also. So that's a B question. You try it for 5 minutes and try to tell me the answer. First part. Calculate the number of units purchased by Mr. Raj at the beginning of the investment. So I'm displaying the question on the screen. 5 minutes time. Everybody clear? So do not worry. Okay, this is a tricky question. If this question appears in examination, 99% of the students will not solve it. Okay, you need not worry. Even CA final or CMA final, whoever. Okay, clear? So first one, calculate the number of units purchased by Mr. Raj at the beginning of the investment. So what is the clue given? So here entry load is 0.05. Entry load 0.05 per unit. By the end of the year, NAV appreciated by 13.6%. 13.6%. Yes or no? Year-end NAV is given. What is the year-end NAV? Year-end NAV is equal to 25. As a result, the investor held 15,000 at year-end. How many units are there? 15,000. So what is the year-end NAV? Year-end NAV is equal to what? 25. Okay. So now let us start this question. Let us assume, note on the solution. Let us assume NAV at the beginning is equal to what? X. Let the NAV at the beginning is equal to what? X. Okay. Number of units is equal to what? Y. Number of units is equal to what? Y. Okay. Number of units is equal to Y. We do not know number of units and we do not know what? NAV. So now tell me total investment is equal to number of units Y into X plus we have a entry load. What is the entry load? 0.05. 0.05. So we do not have any idea about what? We do not have an idea about what? Total investment. Number of units we do not know. At the same time, what? We do not know the issue price also. Issue price. Okay. We are assuming NAV at the beginning is equal to X and number of units is equal to what? Y. So total investment is equal to Y into X plus 0.05. Okay. So now, what is the total capital gain and dividend? Total capital gain and dividend is equal to rupees 5 per unit, which were reinvested at the year-end NAV of rupees 25. As a result, the investor held how many units? 15,000 units at the end. So what are the number of units at the end? 15,000 units at the end. Am I clear? So now, And also we have a given NAV at the end. What is NAV at the end? NAV at the end is equal to NAV at the end is equal to rupees 25. NAV at the end is equal to rupees 25. Okay. So tell me the total dividend. Total dividend is equal to total dividend. What is the dividend amount? Capital gain and dividend 5 rupees into what are the number of units at the beginning? We assume number of units at the beginning as y. Yes or no? So 5 into y. Yes or no? Okay. Next, number of units purchased at the end. Number of units purchased at the end is equal to 5y divided by 25. So these are the number of units purchased at the end. I mean dividend is reinvested, yes or no? So dividend is reinvested at the rate of what? Dividend is reinvested at the rate of 25. NAV at the end is 25. NAV at the end is equal to 25. So number of units purchased at the end is equal to 5y divided by 25. So that means 5y divided by 25. Y plus, so what is this y? Initial units. So initial number of units of y, okay, plus y is equal to what? Y plus 5y divided by 25 is equal to what? 15,000. Clear? Can we find out y or not? So y is equal to 12,500. Very good, Amma Vishnu. Encourage Vishnu. Y is equal to 12,500 units. Vishnu, he told the correct answer. Everybody please, online students, encourage him. 12,500 units. These are the number of units at the beginning. Number of units at the beginning. Clear? Number of units at the beginning. Next part. NAV at the end is given. What is NAV at the end? NAV at the end is equal to what? 13.6%. 6, so 25. NAV at the end is equal to what? 25. So by the end of the year, NAV appreciated by what? 13.6%. So simple that we can do is, if NAV at the beginning is 100, by the end of the year, it has got increased to 113.6%. So we have to find out what? 100. We have to find out 100. So NAV at the beginning is equal to NAV at the beginning is equal to, so what is NAV at the beginning? NAV at the beginning is equal to, okay, so what is the calculation? 25 into 100 divided by 113.6. 22. 22 point. 22 point. Okay, so 22. 22 is the NAV at the beginning. Am I clear? Done. Okay. So that means, so they have asked what the second part. What is the second part of the question? Calculate the NAV per unit. So what is NAV per unit? 22. And next what? Total investment amount made by Mr. Raj at the beginning of the year. So total investment. So B part. Total investment is equal to 12,500 units, right? 12,500 into 22 is the NAV plus entry load 0.05. 2,75,625. So 2,75,625 rupees is the answer. So NAV at the beginning and also what? Total investment. Total investment. Clear? Done. Everybody, is it clear? Online students? My writing is not good. Please do adjust. Next, C part. C part. So what is the C part? They are asking you to find out the NAV, I mean, appraise the return percentage. They are asking you to find out the return. And also what? Real return. What is this real return? Okay. So this is important from examination point of view also. 1 plus real rate into 1 plus inflation rate is equal to 1 plus nominal rate. 1 plus real rate into 1 plus inflation rate is equal to what? 1 plus nominal rate. Nominal rate. So I will tell you what is the meaning of this real rate and nominal rate. You know the meaning of GDP, yes or no? GDP means value for goods and services produced during the year in a country. Like, yes or no? Sorry. Okay. So I will give you a simple example. For example, I am selling one SFM class. Okay. So this year, for suppose I am selling only one class for rupees 12,000. Okay. So that means what is the value of a service given? 12,000. So I have contributed to the GDP of India, 12,000 rupees. Yes or no? Okay. Next year again, okay, as my writing is not good, so only one student enrolled my for class. Only one student. Okay. Only one student enrolled for class. But this time, okay, the course price is 13,000. 13,200. Course price is what? 13,200. Clear? So for suppose in India, only myself is working, let us assume, okay, myself is working and only I am providing the service in India, entire India. So last year GDP is 12,000 and this year GDP is 13,200. Now this 13,200 is called as a nominal GDP. Okay, it is manipulating. In reality what? If you see the growth in GDP, from 12,000 GDP has got increased to what? 13,200. So 1200 divided by 12,000, that means GDP growth rate is 10%. But in reality, there is no growth in GDP. In reality, because what? Last year, only one student enrolled. This year also, only one student enrolled. So this 10% is called as what? Nominal GDP. So this is little manipulative. Because of inflation, there is a growth. So that we cannot take as a basis for what? Performance. So that's why what we do is, we take a real rate. Real rate here is 0. Real rate is 0, yes or no? Earlier one student, now also what? One student. Real rate is what? 0. So that's why in this question they are asking you to find out what? Return percentage as well as what? Real rate. Why they are asking real rate? Because we have an inflation. I will tell you a harsh reality. Okay, when I qualified CA and CMA, so I have secured job in Coal India Limited. Okay. So when I secured job in Coal India Limited, my package was 12 lakhs. So everybody happy and shocked. So this fellow, he got 12 lakhs. Okay. So everybody were crazy. Yes or no? Now also, so okay, now, okay, after 10 years also, if some student gets a package of 12 lakhs, we celebrate. Okay, so tell me in reality whether there is a growth in salary of a CA or CMA or not. There is no growth. Corporate company profits are increasing. Okay, inflation is increasing. 10 years back, okay, if you want 1 BHK in Chennai or Hyderabad, you can get it for 10,000 or 8,000, 6,000. Okay, but here now in Hyderabad, Okay, for 1 BHK, at least you should spend at least 20K, not 16 or 15. Okay, you might be having own house. Okay, so 16. 2 BHK rent 30K. 30K. But whereas the fresher is getting the same salary. Fresher is getting what? Same salary. That means what? There is no real growth in salary. Not real growth. There is no nominal growth also. There is no nominal growth also, because 10 years back the same salary, now also what? Same salary. Clear? So likewise here also they are asking you to find out what? Nominal rate. If you see this formula, frequently asked MCQ, 1 plus RR. RR means what? Real rate. If you add inflation to the real rate, you will get what? Nominal rate. So, but we cannot directly add inflation to the real rate. So we do compounding. So that's why 1 plus real rate into 1 plus inflation rate is equal to what? 1 plus nominal rate. 1 plus what? Nominal rate. Clear? Okay. So we have to find out what? Okay, here real rate. So first we should find out the normal rate. Normal rate. Okay. So write down calculation of return percentage. Calculation of return percentage. Calculation of return percentage and real rate. So they're asking you to find out what? Real rate. So the return percentage, what we are finding out is what? Nominal rate. That is nominal rate. Because of inflation, what happens? Because of inflation also the security price will increase. If there is a pen manufacturing company, even though the sales quantity is same, but the selling price might increase due to inflation. Okay, their profits might increase, but in reality what? The production is same. Okay, so calculation of return percentage and what? Real return. So take sale value, net sale value. Net sale value is equal to 15,000 into 15,000 into what? 25. 15,000 into in brackets take 25 minus what? Exit load. So we have a exit load. What is exit load? Exit load is 1%. So 15,000 into what? 3,71,250. 3,71,250. Clear? Okay. So 25 minus 1%. 25% minus 1% means what? 24.75. Okay. Next. So what is the amount? Tell me the amount. 3,71,250 minus what is investment at the beginning? 2,75,650. So this is the profit, right? But this is profit before tax. We have a tax given here. 20% is the tax rate. Minus tax at the rate of 20%. Minus tax at the rate of 20%. So then tell me what is the profit after tax? 76,500. So 76,500 divided by investment. 76,500 divided by what? Investment. Okay, 76,500 divided by what is investment? 2,75,625. So what is the percentage? 27.75. So what is this 27.75? Real. This is the nominal rate. Okay. Clear? So this is the normal rate. So what is the normal rate? Normal rate is equal to 27.75. Next, write real rate. Real rate means we should remove the effect of inflation. real rate is equal to 27.75. 27.75 divided by what? What is inflation? 4.5. 4.5. So that's why divided by what? 104.5 percentage. 104.5 percentage. Everybody, is it clear? Harshini, is it clear? $26 point what? 55. 26.55. Clear, Harshini? Done. So this concept is very important for MCQ also. For MCQ, same concept. So tested in Forex last time. Tested in Forex. You should understand this concept. 1 plus real rate into 1 plus inflation rate is equal to 1 plus nominal rate. Are you getting my point? I have given a simple example. Okay. So Varun, Martin. So this is the CA final past question. September 25, latest question. So clear? Shall we move on to the next question? Dividend equalization. Dividend equalization. This is a practice question. Dividend equalization. Dividend equalization. After mutual funds, we can have a break. Dividend equalization. In this question, the special point is dividend equalization. On 1st April, an open-ended scheme of mutual fund had 300 lakh units outstanding with NAV of 18.75. At the end of the April, it issued 6 lakh units at opening NAV plus 2% load, adjusted for dividend equalization. Adjusted for dividend equalization. At the end of May, 3 lakh units were repurchased at opening NAV less 2% exit load. So this is May 2025 CA final question. May 2025 CA final question. And one attempt I have done a mistake. Because in CMA final study material, we have no concept relating to what? Dividend equalization. In exam oriented batch, I have explained all the questions except this question. I thought like why they will test this advanced question. But next attempt what? In old syllabus, they have tested this question. But luckily in new syllabus, they haven't tested. And our student got all in the first rank. Okay. So still I regret. So that's why I don't want to take chance. At the end of the June, 70% of its available income was distributed. In respect of April-June quarter, the following additional information are available. Portfolio value appreciation, income of April, income for May, income for June. You are required to calculate income available for distribution, issue price at the end of April, repurchase price at the end of May, NAV as on 30th June. They are asking you to find out the income available for distribution. Here in this question, we have a special point, dividend equalization. What is this dividend equalization? So dividend equalization is similar to a goodwill. For example, if already 3 partners are working from 3 years, and if a 4th partner, Pravalika, wanted to join in partnership, will you take only capital? Will existing partners take capital? No. They will be taking what? Capital plus goodwill. Yes or no? Likewise, an outgoing partner will take capital plus what? Goodwill. Likewise here also. See, we have an income of April. We have an income in April. What is income in April? 22.95. At the end of April, it issued 6 lakh units at opening NAV plus 2% load, adjusted for dividend equalization. Simple concept. Okay. So already how many units are there? 300 lakh units are there. 300 lakh units. How many units? 300 lakh. Okay. Let us assume in this 300 lakhs, Sahil is holding 297 lakh units and 3 lakh units are held by Pandu, Vishnu. Okay. Okay. Clear? At the end of April, 6 lakh units at opening NAV plus 2% load adjusted for dividend equalization. At the end of April, 6 lakh units are issued. Understand the question. From the beginning, on 1st April, there are 300 lakh units. In 300 lakh units, 297 lakhs were held by Sahil and 3 lakhs were held by Vishnu, Pandu. Okay. Now, at the end of April, 6 lakh units were issued and these 6 lakh units were purchased by Pravalika. Okay, so Pravalika is joining the mutual funds at the end of April. Yes or no? Okay. So what is this dividend equalization? If you see the line here, at the end of June, 70% of its available income was distributed. 70% of its available income was distributed. Okay. So when the income gets distributed, income of April, May and June, 3 months income will be distributed. So Pravalika will be standing in the queue for share in income, yes or no? So giving a share in April income is correct or not to Pravalika? To Pravalika we cannot give share in April income because she is joining in mutual funds at the end of April, yes or no? But while we distribute the amount at the end of June, she will get share in April, May and June. So that's why what we do is we collect dividend equalization from the incoming investor for the month of April. Okay. So that again at the end of June we distribute. Then what happens? So that will get offset. Clearer? Likewise, at the end of May, 3 lakh units were repurchased. At the end of May, 3 lakh units were repurchased at opening NAV less 2% exit load adjusted for dividend equalization. What is this point? At the end of May, one person is going out, repurchased. We are repurchasing and sending the person out. Who is that person? Pandu. 3 lakh units. So Pandu is leaving the mutual funds at the end of May. But we are distributing the income at the end of June. By the time we distribute the income at the end of June, Pandu will not be there, yes or no? So that means what? It is unfair, totally unfair, because he is with mutual fund in the month of April and May. So that's why what we do is, at the time of exit, we pay income of April and May, his share to the outgoing investor. This concept is called as what? Dividend equalization. Simple concept. If you understand, it is very simple. Okay. So first part, they are asking you to find out what income available for distribution. Income available for distribution. Income available for distribution. What is the income of April? I'm just writing the numbers. What is the income of April? 22.95. 22.95. So at the end of April, who is joining here? Okay, so we are issuing 6 lakh units. 6 lakh units. So we collect 22.95 divided by 300 lakhs. 22.95 is the income of April divided by 300 lakhs. You will get income per unit. Into what? 6 lakhs. 0.459 will be collected from what? Incoming investor. So to equalize the existing investor and incoming investor, we collect a dividend equalization from incoming investor. Clear? So what is the amount? 23.47. 23.409. Clear? Next, add income of May. What is the income of May? 34.425. So this is the total income by the end of May. Next, one person is going out. Who is the person? Pandu is going out. 3 lakh units. We should pay dividend equalization. What is the dividend equalization paid? 57.834 divided by 306. 57.834 divided by 306. Total number of units are 306. Into 3.567. So then what is the remaining amount of 57.267? And add income of June. Then you will get total income minus what? Dividend paid. What is the dividend paid? 70%. So this is the balance income. This is the balance income. Clear? Everybody able to understand this question? Done? So you can take only single column. With single column you can manage. Okay. So that I have already given single column. Clear? Particulars and amount. Next, the calculation of issue price at the end of April. Calculation of issue price at the end of April. So here issue is made at the price of issue is made at opening NAV. What is the opening NAV? 18.75. 18.75 plus entry load. What is entry load? 2%. Entry load are the charges collected from the investor. So that has to be added to the opening NAV. And add dividend equalization. Why add dividend equalization? We have to collect dividend equalization from the incoming investor. What is the dividend equalization? We should take per unit. How do we get per unit? 22.95 divided by 300 lakhs, 0.0765. Issue price at the end of April, 19.2015. Next, repurchase price at the end of May. Repurchase is also made at opening NAV. What is the opening NAV? 18.75 minus entry load. What is entry load? 18.75 into 2%. Clear? Here also we are adding the dividend equalization. Why we are adding the dividend equalization? We have to pay the dividend equalization to the outgoing investors. So that's why add. So what is the calculation? 57.834 divided by 306. Exit load, yeah. Opening NAV minus exit load. Opening NAV minus exit load. Add dividend equalization. Dividend equalization 57.834 divided by 306. 0.1890. So this is the repurchase price. I hope you understood the concept of dividend equalization. This is simple. And next, the calculation of NAV. Calculation of NAV. Opening NAV 18.75 into 300 lakhs plus portfolio value appreciation. What is the portfolio value appreciation? 425.47. Issue of a fresh units. How many fresh units are issued? 6 lakhs into 19.2015. Income received. Total 3 months income. Next, minus units repurchased. 3 into 18.564. That has to be reduced. Minus income distributed. So this is the closing NAV. Closing NAV divided by closing units. How many units are there? 300 plus 6 lakhs minus 3 lakhs. So 20.267. So this question is for practice. So this is a May 2025 CA final question. So recent CA final exam questions, high chance they might ask in exam. Clear? So go through this question. I mean, you have to practice this 10 minutes. Now the time is 5:08. 5:08. By 5:18 complete this question. Let's see 16th question. Sharp ratio, Trainer's ratio and Jensen's alpha is the basic question. You know the sharp ratio. RP minus RF divided by sigma P. Yes or no? Jensen's alpha. Actual return minus CAPM return. Trainer's ratio. RP minus RF divided by beta P. So you know the concept, right? So 16. So this question need not be referred. This is a basic question. 17th question. In 17th question, there is only one special point. They have asked you to find out the unsystematic risk. Do you remember the systematic risk formula? What is the systematic risk formula? Beta S square into sigma M square. Unsystematic risk is equal to sigma S square minus beta S square sigma M square. Yes or no? But here in this question, so unsystematic risk is calculated simply by reducing the beta from standard deviation. So which is not actually not correct, because standard deviation is a percentage, beta is a ratio. Beta is a ratio. In question number 17, 17 is for referral. The 17 only special point is what? 7 minus 1.25. So beta is equal to, so unsystematic risk is equal to 5.75. That is the only special point. Remaining and all is same. So, and one more theory part they are asking, there are two measures, Sharpe ratio and Trainer's ratio, which is the better one. Sharpe ratio is the better one, more appropriate, because it is considering total risk than the systematic risk. Okay. So 17 only special point, standard deviation minus what? Beta. You will get unsystematic risk. 18th question, December 2024 question. 18th question, December 2024. NAV at the beginning is given, NAV at the end is given. Sorry, NAV end, we have to find out. NAV beginning is given in 18th question. So we have to find out NAV at the end. Okay. And the clue given is Sharpe ratio is given, Trainer's ratio is given, standard deviation is given. And one more clue they have given is the share market goes down by 5%. Share market goes down by 5% means share market goes down by 5%. So to find out the NAV at the end, we should find out the beta. How can we find out the beta? We have a Sharpe ratio, Trainer's ratio, and standard deviation. By using the Sharpe ratio and Trainer's standard deviation, we can find out RP minus RF. By using RP minus RF and Trainer's ratio, we can find out beta. If you know the beta, so we can determine what share market goes down by 5% means the share market goes down by 5%. That means what? The equity of D mutual fund will also reduce. So that percentage we can find out by finding out the beta. Okay. So question number 18, you just refer this question. So this is December 24 question. So less chances of asking in December 2025. Clear? Okay. But so I have explained it. Using Sharpe ratio and standard deviation, we find out RP minus RF. And next what? Trainer's ratio, we can find out what? Beta. And later on what? We can find out the new equity value and also new cash balance. So now comes the practice question. Question number 19. This question is for practice. This is a CA final past question. CA final past question. We cannot take chance. This question you have to practice this question. I will explain now, but you have to practice this question. So now I am going to explain question number 19, 20 and 21. Three questions. These three questions are very, very important. I'll explain these three questions. Immediately after this session, you have to practice these three questions at once. Okay. Miss Sunidhi is working with an MNC at Mumbai. Sunidhi is working with MNC at Mumbai. She is well versed with the portfolio management techniques and wants to test one of the techniques on an equity fund she has constructed and compare the gains and losses from the technique with those from a passive buy and hold strategy. The fund consists of equities only, and the ending NAVs of the fund he constructed for the last 10 months are given below. December to September NAVs are given. Assume Sunidhi had invested a notional amount of rupees 2 lakhs equally in the equity fund and a conservative portfolio of bonds in the beginning of December 2008, and the total portfolio was being rebalanced each time the NAV of the fund increased or decreased by 15%. You are required to determine the value of the portfolio for each level of NAV following the constant ratio plan. So you are required to determine the value of a portfolio for each level of NAV following the constant ratio plan. So we have to follow what? A constant ratio plan. Here I will take at least 5 minutes time to explain this question, because generally students will forget the concept. So what is this? You are required to determine the value of a portfolio for each level of a NAV. What is the portfolio? Assume Sunidhi had invested a notional amount of rupees 2 lakhs equally in the equity fund and conservative portfolio for bonds in the beginning of December 2008. In the month of December, she invested 2 lakhs equally in equity and bonds, 1 lakh in equity and 1 lakh in bond. And the total portfolio was being rebalanced each time. The total portfolio is being rebalanced each time. The NAV of the fund increased or decreased by 15%. Generally, when you read the question for the first time, you will not understand the question. So Sunidhi, she is rebalancing the portfolio whenever the NAV decreases or increases beyond 15%. NAV decreases or increases beyond 15%. Okay, increases or decreases beyond 15%. Clear? So total portfolio being rebalanced. What is this total portfolio rebalancing? Here they are following a constant ratio. What is this constant ratio? Constant ratio means she invested equally, right? Equity 50, debt 50. So whenever the NAV falls, increases, for example, NAV increases. If NAV increases, what happens? Equity investment value will increase and the ratio will not remain same. Okay, if NAV decreases, equity value decreases and the ratio will not remain same. But she wanted to maintain a constant ratio. Constant ratio, what is that ratio? 50:50. So that's why she do a rebalancing. She do a rebalancing whenever NAV increases or decreases beyond 15%. And she wanted to compare the gains and losses from the technique with those from passive buy and hold strategy. We have a passive buy and hold strategy. Passive buy and hold strategy means just invest and wait till the end. So that is passive buy and hold strategy. But her technique is what? Investing 50% in equity, 50% in debt, and comparing the gains and losses from this technique with passive buy and hold strategy. She do a rebalancing whenever the NAV increases or decreases beyond 50%, 15%. Okay. So let us see the question first. Let us see this question. Constant ratio plan. What is NAV at the beginning? 40. How the investment is made? Investment is made 1 lakh in equity, 1 lakh in what? Debt. Overall amount is 2 lakhs. Okay, so there is no revaluation action. How many units are there at the beginning? 1 lakh is invested in equity. What is NAV? It is an all equity fund, all equity fund. So that's why 1 lakh divided by 40. How many units? 2,500. 2,500. Is it clear? Done. Next, NAV. Next time, NAV decrease it to what? Next, NAV decrease it to 25. NAV decrease it to 25 means what is the percentage change? What is the percentage change? 40 to 25. 40 minus 25 divided by 40. So the percentage change is 37.5. That means there is a decrease beyond 15%. So that's why we do rebalancing. What is this rebalancing? So now, if NAV decreases, what happens to the bond value? Bond value will not change. Bond value will remain same, but equity value will decrease. Equity value will decrease to 2,500 into 25. 2,500 into 25, 62,500. So the overall value is 1,62,500. 1,62,500. Now what we do is we do a rebalancing. We do a rebalancing. Everybody please do understand this is the point. 1,62,500 is the total value. So the ratio has got changed because of decrease in NAV. 1 lakh and 62,500. They are not following the 50-50 ratio. So that's why we do a rebalancing. Rebalancing means we divide the total investment into two equal parts. Bond 81,250 and equity 81,250. So what does that mean? We sell 1 lakh minus 81,250. That is 18,750 rupees worth of bond when we buy equity worth 18,750. We sell 18,750 rupees worth bonds and we buy 18,750 worth equity. So how many units are we going to buy? We are going to buy additionally 750 units. So the total number of units is 3250. Clear? Next, what is the next NAV? 36. So what is happening? NAV is increasing. What is the percentage increase in NAV? Percentage increase in NAV is equal to 25 minus 36 divided by 25. What is the percentage change? 44%. That means beyond 15%. Beyond 15. So let us find out the revised value. Bond value will not change. 81,250. Equity value will change. What is the equity value? 3250 into 36. 1,17,000. So 1,98,250. So again this 1,98,250 will be distributed between bond and equity equally. 99,125, 99,125. Clear? Huh? So here we are going to sell equity. We are going to sell equity. We are going to sell equity and purchase bond. How many units we are going to sell? First of all, how much equity are we going to sell? 1,17,000 minus 99,125. That means 17,875 divided by 36. So 496.53. So these are the remaining units. 2753.47. Am I clear? Done. Okay. So now the point is, so likewise we have to do what till the end? Till the end. How many units are there at the end? 2359.3. Okay. 2359.3. What is the ending value? Ending value is equal to equity value 2359.3 into 52. Bond value 1,17,965. The overall value is 2,40,648. So this is the value of a fund at the end. Okay. So there is another strategy. What is the another strategy? Passive buy and hold strategy. Passive buy and hold strategy means investing in equity at the beginning and waiting till the end. So what is the value if you are following the passive buy and hold strategy? 2 lakhs divided by 40 into 52. 2 lakhs divided by beginning NAV 40. You will get 5,000 units into 52. So 2,60,000. So which is the better one? Which is the better one? So okay, 2,60,000. So it is better to follow what? Passive buy and hold strategy. This question you have to practice. And we are not going to do rebalancing if the percentage change is less than 15%. For example, what is the next NAV? 32. From 36 to 32. 36 to 32 means NAV decreases by 4 rupees. So 4 divided by 36. 4 divided by 36. 11.11. 11.11. That means no rebalancing is required. So that's why 187, 221, no revaluation action. Clear? Everybody, is it clear? You have to practice this question immediately after this session. Immediately after this session. Next, see the 20 question. Question number 20. Pharma's net selectivity. Pharma's net selectivity. At a stretch, you have to practice all the 3 questions. Question number 20. The following information is available regarding 3 mutual funds. Fund A, B, C. Average return 24, 16, 12. Standard deviation 843. Correlation with market 0.3, 0.7 and 0.5. If the risk-free return is 6%, return on the market is 15% with a standard deviation of 4% respectively. Find out the total gain, net gain under Pharma's net selectivity, systematic risk and unsystematic risk. Systematic risk and unsystematic risk. Total gain means nothing but actual return minus CAPM return. Net gain means actual return minus CML return. Actual return minus CML return. Actual return means nothing but average return. Here the average return is given 24%. So what do we require? We require CAPM return. How do we get CAPM return? RF plus RM minus RF into beta. So to find out the beta, what is the information given? Correlation with market is given. Correlation with market means sigma SM. Sigma SM. Sigma SM, sigma S is there. Sigma M is also there. So 0.3 into 8 divided by 15. So what is the beta? 0.6 16 0.3 into 0.6. Clear? So CAPM return is equal to RF plus RM minus RF into beta. So the answer is 11.4. CML return, capital market line. What is the capital market line? RF plus RM minus RF into sigma S divided by sigma M. CML return is equal to RF plus RM minus RF. Sigma SC is there, sigma M is also there. Sigma M is also there, 24. Now, what is the net gain? How do we get net gain? Net gain is equal to actual return minus CML return. CML return. So the answer is 0. Next, the total gain is equal to actual return minus CAPM return. So CAPM return is equal to actual return minus CAPM return is equal to 12.6%. Likewise, we have to find out for what B and C also. So this is a simple concept, but you might get confused between net gain and total gain. Be careful, total gain. Actual return minus CAPM return, Jensen's alpha. Next what? Net gain, actual return minus CML return. Next is systematic risk and unsystematic risk. Total risk, we take variance, sharp index model, we take variance. Systematic risk, beta S square into sigma M square. Beta already there, sigma M is also there. So unsystematic risk is equal to sigma S square minus beta S square into sigma M square. Clear? But in suggested answer, different answer is given. So what is the different answer? They have taken total risk. They have taken total risk 8. They have taken what? Total risk 8. Nothing but instead of variance, they have taken what? Standard deviation. Clear? Systematic risk. You know that systematic risk. How do we get systematic risk? Beta S into sigma M. For suppose instead of variance approach, they are following standard deviation approach. At least in deviation approach, instead of taking square, they should take what? Beta S into sigma M. But they have taken beta S into sigma S. That means 0.6 into 8, which is not at all correct. Beta into what? They have taken, instead of beta into sigma M, they have taken what? Standard deviation of a security, 0.6 into 8. That means 3.2 or 4.8. 4.8. 4.8 is the systematic risk and unsystematic risk is equal to 3.2. So this is the answer given in what? Suggested. Okay. If the same question appears in examination, if you remember the suggested answer, you better write what? A suggested answer. Okay. And also what? Our answer also. Which is the correct one? Our answer is correct because beta S square into sigma M square. Beta denotes the relation between security and market, not security and security. Not security and security. Clear? Next one. Next, let us come to the next one. 21. So this is very, very important question, A++ question. The following information is available for mutual fund A, mutual fund B and market portfolio M for 6 months. Month A, April, May, June, July, August, September. Fund A, fund B, market portfolio. Returns are given. 6 returns are given. Fund A, fund B and market portfolio. Risk-free interest rate is 6% per annum. Compute average return, risk of a loss of a fund A, B and M. Compute the Morningstar index of A, B and M. Compute the standard deviation of the returns of A, B. Calculate the Sharpe ratio of A. So first they are asking you to find out the average return and risk of a loss of a fund A, B and M. Okay, average return. They are asking average return and also what? Risk of a loss. See here. Month April, May, June, July, August, September. RF is given. Risk-free rate. What is the risk-free rate? 6%. 6% is per annum, but we should take per month because month-wise returns are given. So that's a 6 divided by 12. 0.5. Now returns are given already. What is the return? 3. 1.75 minus 1, 3.5, 1.5, 0. Clear? So we should find out the average return as well. How do we get average return? Average return is equal to total 3 plus. Here the average return is missing 3 plus 1.75 minus 1 plus 3.5 plus 1.5 plus 0 divided by what? 6 months. You will get 1.46. You will get 1.46. Here average return is missing. Average return is missing. It is 1.46 average return. In second part directly written 1.46. Fund B. Fund B average return same 2.25 minus 1.25 0 3 2.5 and 1 total divided by 6. You will get 1.25 average return. But here the new point we are going to learn is risk of a loss. What is this risk of a loss? Risk of a loss means a loss we incur due to the risk. Loss we incur due to the risk. What is the loss? First case, see the return. What is the return? 3. Fund A return is equal to 3%. What is the risk-free rate? 0.5. Risk-free rate 0.5. So instead of investing in risk-free security, I have invested in fund A. Due to investment in fund A, whether I got any loss or not? No, I have not incurred any loss. So that's why risk of a loss is equal to 0. Risk of a loss is not the difference between RF and return. Risk of a loss means loss we incur due to the risk. So first case, instead of investing in risk-free security, I have invested in fund A. So I have incurred any loss or not? No, I have not incurred any loss. Second case, no loss, no risk of a loss because my return is 1.75. But third case in fund, the loss is -1. That means due to risk, I lost minus 1.5, 0.5 and -1, minus 1.5. What about July? July, no risk of a loss. August, no risk of a loss. September again, I lost 0.5. So overall, my risk of a loss for 6 months is 2. Overall, for 6 months, my risk of a loss is 2. On an average, my risk of loss is 0.33. So this is a simple concept. 0.33 is the risk of a loss. Am I clear? Done. Now come to Morningstar index. Likewise, we should find out for what? Fund B and market. Next, Morningstar index. Morningstar index is nothing but simple average return minus what? Average return minus risk of a loss, 1.13. Higher the Morningstar index, better it is. Higher the Morningstar index, better it is. 1.13, 0.87 and 1. And they have asked you to find out the standard deviation that we already know how to find out the standard deviation. How do we get standard deviation? X bar, x minus x bar, x minus x bar whole square. Past data is given. Okay, so we can find out the standard deviation very easily. So they have asked the standard deviation of fund A and fund B. And also what? Sharp ratio. How do we get sharp ratio? RP minus RF divided by sigma P. RP minus RF divided by sigma P. So 1.46 minus 0.5 divided by what? Standard deviation 1.57. So 0.611 is the answer. Clear? Okay. So whatever the questions I have not discussed in this class, you have to refer those questions. But the questions mainly which I have discussed, you have to practice those questions. So okay, immediately after this session, immediately after I end this session, you have to practice 3 questions. One is constant ratio plan. Second, PAMA's net selectivity. And next what? Risk of a loss. Risk of a loss. Okay, you will get the questions which we discussed in the class in examination. But the point is, if you are not practicing, you will not be able to do. So that too within the time. Within the time. So everybody clear? So with this we have completed what? Mutual funds. We completed what? Mutual funds. Mutual funds weightage is 7 marks plus 2 marks multiple choice questions. Okay. So mutual funds MCQ is also the same. They will ask you to find out R2. R2 is equal to R1 divided by 1 minus initial expenses plus recurring expenses. Recurring expenses. So they will be asking simple questions. So descriptive. For example, we have calculated NAV at the end. Sometimes holding period return is given, and but they have asked you to find out what NAV at the end. So you can easily solve this. Okay. Clear? Everybody, is it clear? So now immediately without wasting time, please do practice question number what? 19, 20 and what? 21. Especially 19th question, you will find it new. After 10 days or 20 days, if you read the same question, you will find the question new. MCQs, that's what I'm saying. MCQs, simple MCQs only. Okay, I have listed here bullet MCQs only 11 MCQs. 11 MCQs, simple MCQs only. For example, if you see the 11th question, they are asking you to find out what trainers ratio, December 17. How do we get trainers ratio? RP minus RF divided by beta. So there are no special MCQs in this question, so that's why I'm not explaining. Clear? If you see the 10th question, R2 calculation, R2 is equal to what? R1 divided by 1 minus initial expenses plus recurring expenses. So there are no special one. So everything we have covered. So that's why just go through these 11 MCQs also. 11 MCQs. After analyzing all past MCQs, I have listed 11 MCQs. If you see the June 2023 MCQ, simple. What was the NAV as on 31st March 2024? So what is given? Annualized yield is given. Annualized yield is given. So investment is made on 1st August. Be careful. First this annualized return, we should convert this annualized return into holding period return. And then what? Apply the formula NAV1 minus NAV naught plus income divided by NAV naught. So these MCQs are simple. Okay. So there are no special MCQs. So that's why I'm not discussing. There are only 11 MCQs listed. So go through these 11 MCQs. Okay. Clear? So tomorrow Forex class, I'm going to start Forex class up to question number 17. Okay. Up to question number 17. So we are going to cover up to currency options. Currency options. Mostly tomorrow I will not give time to practice, but I will be solving the questions. Okay, I will be solving the questions. If you listen to the first 1 hour class, you will be able to answer 1 MCQ. If you listen to the next 2 hours class, you may be able to answer the another 1 descriptive question. If you listen to the complete class, then you will be able to answer 2 descriptive 7 marks questions and what 1 MCQ. Okay, so the total weightage of the tomorrow's class is what? 16 marks. 16 marks is the weightage, foreign exchange exposure. And my suggestion, if you are not able to practice portfolio management, mutual funds, derivative questions within the time, you better take choice Forex. That depends on you. That depends completely on you. Okay. So if you are able to comfortably, for suppose if you are comfortable, when I'm giving time to practice, if you are able to complete the question, or else if you are able to complete at least within 15 minutes, then you better attend Forex class. So that completely your decision, I cannot say. Okay. So depending upon the time availability, you attend tomorrow. Okay. Otherwise, you just restrict yourself to which topics? Mutual funds, derivatives, portfolio, security, valuation, ERP, evaluation of risky proposal, and theory topics, IFM, digital finance, securitization. Clear? Okay. So are you comfortable with derivatives? Are you able to do derivatives? Everybody? So what about mutual funds? Portfolio management, security valuation. Security valuation, I'm not talking about the extremely new questions. So for suppose if the same question is being asked in examination, are you able to understand the concept? First point, okay. So for example, the last attempt June 25 question is completely new. So that is different. But the point is, are you able to understand the questions or not? Are you able to understand the concept or not? If you are able to understand the concept, that's okay, fine. You can attend tomorrow's Forex class. Clear? And in 15 minutes reading time, you have to take a wise decision. Which question you have to take choice? Which question you have to take choice? You have to take a wise decision. In 15 minutes, you have to choose the questions. So, okay, after seeing the question paper, you will get to know, whether known questions are being asked or not. Clear? Sahil, is it clear? So students who are writing both, so be careful, okay? So you have to depend on tomorrow's class instead of going for regular forex class. Better you what rely on tomorrow's class. Okay, if you are writing both. Clear, Sahil? Swati? Harshini? So CA final question. I have not written properly solution. So you better what write the solution properly and please share that solution in Telegram group. Okay. Thank you. Thank you, Harshini. Sahil. Meet you tomorrow. Thank you all.